Picture this. It is Thursday, February 13th, 2026. Silver is sitting at $83 an ounce, down 32% from $121 just 2 weeks ago. Gold is hovering around $5,050. The S&P 500 is at all-time highs. And somewhere, right now, a financial advisor is telling a client to stay the course, keep buying the index, dollar cost average, set it and forget it, and everything will be fine. That advisor is either lying to you or they genuinely do not understand what is happening underneath the surface of this market. And today, I am going to show you exactly where the smart money is actually going, because it is not where you think. Before we go any further, drop a comment telling me where you are watching from right now. Are you watching this from New York after a long day staring at red candles? Are you in London checking your phone before bed because you cannot stop thinking about what happened on January 30th? Are you in Tokyo, in Sydney, in Dubai? Let the world see that this community is global. Drop your city and what time it is there. And if this is your first time here, hit that subscribe button right now, because I publish daily silver intelligence that mainstream financial media will not cover. This channel is your real-time news desk for precious metals. Now let me tell you why I am making this video today. A video is going viral right now in the finance space. Millions of views. And the thesis is essentially this: the S&P 500 is a trap. The Magnificent Seven tech stocks are in a bubble. Valuations are insane. AI spending is circular. Companies are buying from each other and calling it revenue. Insiders are selling at record levels. And retail investors, that is you and me, are the exit liquidity. And you know what? That analysis is correct. I agree with almost every word of it. But here is the problem. That video spends 17 minutes telling you your portfolio is on fire. And then it ends with, make a plan. That's it. Make a plan. No alternative. No destination. No answer to the most important question a terrified investor has after watching that video. If the S&P 500 is a trap, where do I actually put my money? That's the question that video does not answer. And that's the question I am going to answer right now. Let me give you the evidence. And I am not going to give you opinions. I am going to give you the forensic trail, the receipts, the data. Because when you follow the money, you do not end up in tech stocks. You do not end up in bonds. You do not end up in cash. You end up in the one asset class that the entire Eastern Hemisphere is hoarding, while the Western financial system pretends it does not exist. Let us start with what the institutions are actually doing, not what they are saying on television, not the press releases, what they are doing with their money. JP Morgan, the largest bank in the United States, just took delivery of 633 silver contracts on the COMEX at $78.29 per ounce. That is over 3 million ounces of physical silver. They did not buy a silver ETF. They did not buy a futures contract to speculate. They stood for physical delivery. They wanted the actual metal in their vault. And they did it on January 30th, the exact day that silver crashed 35%. While retail investors were panic selling, JP Morgan was backing up the truck. Let me say that again so it sinks in. On the worst day for silver in 44 years, the biggest bank in America was not selling. They were buying. And not paper silver, physical silver. The actual bars. If silver was really crashing because the fundamentals changed, if the bull market was really over, if the smart money was really leaving, why was JP Morgan taking delivery of millions of ounces at the bottom? You do not take physical delivery of a commodity you think is going down. You take physical delivery of a commodity you think is about to become very difficult to get. And JP Morgan is not alone. Sprott Physical Silver Trust just doubled its capital raise from $1 billion to $2 billion specifically to buy physical silver. At current prices, That $2 billion represents roughly 18 million ounces. That is 16% of the entire COMEX registered inventory. One single fund is preparing to absorb 16% of the deliverable silver on the world's largest futures exchange. Let that number sit with you for a moment. Now, here is where it gets really interesting, and I want you to pay close attention because this is the part that changes everything. The viral video about the S&P 500 bubble talks about circular money flows, companies buying from each other. NVIDIA sells chips to Microsoft. Microsoft sells cloud to AI startups. AI startups are funded by the cloud companies. Everyone books revenue. Everyone reports growth. No actual end customer. And that is absolutely true for the AI narrative. But silver is the exact opposite. Silver has a real end customer. In fact, silver has millions of end customers that cannot function without it. Every solar panel on Earth requires silver. Every smartphone, every electric vehicle, every 5G antenna, every medical device. Silver is not a story. It is not a narrative. It is not a circular money flow. It is a physical input that gets consumed and is gone forever. You cannot recycle the silver in a solar panel economically. Once it is used, it is removed from the supply permanently. And here is the math that should terrify anyone sitting in the S&P 500 right now. The global silver market has been in a structural deficit for 5 consecutive years. Demand exceeds supply by approximately 200 million ounces per year. That is not a forecast. That is not a prediction. That is the actual measured gap between how much silver the world digs out of the ground and how much the world uses. And it is getting worse, not better, because you cannot just open a new silver mine. 80% of silver is mined as a byproduct of copper, zinc, and lead mining. You want more silver? You need more copper mines. And a new copper mine takes 7 to 12 years to permit and build. So while the S&P 500 is trading on hopes about AI revenue that may or may not materialize in a decade, silver is trading on a physical supply deficit that is measurable, verifiable, and accelerating. Now, let me show you the smoking gun that ties the stock market bubble directly to the silver opportunity. And this is the part I want you to really hear, because nobody else is connecting these dots. The total market capitalization of every publicly traded silver mining company on Earth is approximately $40 billion. The total. Every silver miner, globally. Do you know what Apple's market cap is? Over $3 trillion. One company, one single tech company, is worth 75 times more than the entire global silver mining industry. NVIDIA alone is worth more than 60 times the entire silver mining sector. These are companies whose valuations depend on AI revenue that does not exist yet, trading at multiples that require perfection for a decade. Meanwhile, the companies that produce an irreplaceable industrial metal in a verified supply crisis are valued at less than a rounding error on Apple's balance sheet. If even 0.5% of the money currently sitting in the Magnificent Seven stocks rotated into silver and silver miners, it would be a tidal wave hitting a kiddie pool. The door is too small. The market cannot absorb that flow without prices going dramatically higher. And that rotation has already started. Gold and silver have outperformed the S&P 500 for 3 consecutive years, 2024, 2025, and 2026 year to date. This is not a blip. This is a trend. And the institutional money is just now beginning to notice. I want to give you 3 scenarios for what happens next, because I never tell you silver is just going up. That is not how a forensic analyst operates. I give you the map and let you decide your route. Scenario Alpha, which I am calling the consolidation grind. Probability roughly 40%. Silver trades sideways between $75 and $90 through February and into March. The January crash shook out the weak hands. Volatility decreases. The Shanghai Futures Exchange reopens after Chinese New Year on February 23rd. The FOMC minutes on February 18th provide no surprises. This is the boring scenario, and boring is actually bullish because it means the market is building a base at a level that would have been unthinkable 12 months ago when silver was at $32. Scenario beta, which I am calling the spring-loaded squeeze. Probability roughly 35%. Silver breaks above $90 by late February as the March COMEX delivery month approaches. March is one of the primary delivery months for silver futures. COMEX registered inventory is at approximately 108 million ounces, near 50-year lows. If large traders stand for delivery the way JP Morgan did in January, the math becomes impossible. There is not enough silver to satisfy the contracts. This is where you could see silver retest $100 and potentially push to $120 or higher. Scenario gamma, which I am calling the risk-off flush. Probability roughly 25%. A broader stock market correction drags everything down, including silver temporarily. This is the scenario that the S&P 500 bubble video is essentially predicting. The Magnificent Seven crack, margin calls across equities, force liquidation in all asset classes. Silver drops to $65 or $70. But here is what is critical about this scenario. In March 2020, silver crashed to $11 when COVID hit. 5 months later, it was at $30. Physical silver during that crash was selling at massive premiums because nobody would actually sell their metal at those paper prices. The paper price and the physical price diverge, and that is your buying opportunity of a decade. In every single scenario, the long-term thesis for silver is intact. The supply deficit does not care about margin hikes. The industrial demand does not care about COMEX games. China's export restrictions, which went into effect January 1st, 2026, limiting silver exports to only 44 licensed firms, do not reverse because of a paper price crash. The fundamentals are structural. They are not going away. Now, I want to address something directly. Be honest with me right now. Type "I sold" or "I held" in the comments below. No shame, only lessons. If you sold silver during the January 30th crash, I am not here to judge you. That was a 35% move in 24 hours. The CME hiked margins to 15%. The London Metal Exchange went dark. HSBC systems went offline. It was designed to make you sell. It was engineered to trigger stop losses and margin calls. And while you were selling, JP Morgan was buying 3 million ounces at the bottom. That is not a conspiracy theory. That is COMEX delivery data. It is public information. The question is not whether it happened. The question is whether you will be positioned for the next move. Here is my action framework, and I want to be clear, this is not financial advice. I am not a financial advisor. This is how I think about the current situation as an analyst, and I share it for educational purposes only. If you are a long-term physical holder, the January crash changed nothing for you. Your metal is in your hands. No counterparty risk. No margin calls. The paper price is a number on a screen. The physical market told you the real story when dealers ran out of inventory on February 1st, and premiums spiked to 15 to 20% over spot. If you are looking to enter the silver market for the first time, this correction from $121 to $83 is a gift. Silver is still up over 160% from a year ago. The structural deficit is intact. But do not go all in at one price. Scale in. Buy some now. Buy more if it drops to 75. Buy more if scenario gamma plays out and it hits 65. The point is to be positioned, not to time the exact bottom. If you are currently sitting in the S&P 500 and wondering what to do, ask yourself the question the viral video raised but never answered. What happens if those 7 stocks drop 40% and stay there for 3 years? And then ask the question that video should have answered. What asset has real demand, verified supply constraints, institutional accumulation, and a 3-year track record of outperforming the very index you are worried about? The answer is sitting at $83 an ounce right now. The gold to silver ratio is currently at approximately 62 to 1. The historical average is closer to 50 to 1. Some analysts argue it should be closer to 15 to 1 based on actual geological rarity. If the ratio simply reverts to 50 to 1 with gold at $5,000, silver goes to $100. If it reverts to 40 to 1, silver goes to 125. And if we see the kind of mania that the gold to silver ratio experienced in 1980 when it hit 15 to 1, you are looking at $300 silver. I am not predicting that. I am showing you the math. Comment your silver price target for the end of 2026 below. Are we hitting 100, 150, 200? Or do you think the correction has more room to run? I want to hear both sides. Now, before I let you go, I want you to understand something fundamental about what is happening right now in the global financial system. The East is accumulating hard assets. China restricted silver exports. Central banks bought more gold in 2025 than any year in recorded history. The Shanghai premium during the January spike hit $14 over London prices. Physical silver in Tokyo was trading at $130 when the COMEX paper price said 78. The West is trading paper contracts and trying to pretend this divergence does not exist. But the divergence is the signal. The divergence between paper and physical is telling you that the pricing mechanism is broken. And when the pricing mechanism for any commodity breaks, the resolution is always, always, always in the direction of the physical market, not the paper market. The paper price catches up to reality. It does not work the other way around. If this forensic breakdown is opening your eyes to what is really happening in the silver market right now, smash that like button. Share this video with one other person who needs to hear this. Someone who is sitting in the S&P 500 right now wondering if they should be worried. They should be. But they should also know that there is an alternative. An alternative that is not based on hope, not based on circular revenue, not based on 7 CEOs delivering perfection for a decade. An alternative based on physical reality, on supply and demand, on math. Subscribe for daily silver intelligence. I will be back tomorrow with the latest COMEX data and what it means for the March delivery month. The next 2 weeks are going to be critical. You do not want to miss what is coming. How much silver do you currently hold in ounces? Drop your number in the comments. I do not care if it is 10 ounces or 10,000 ounces. Every single ounce matters. And every single person watching this channel is part of a global movement that is slowly and methodically draining the physical supply from a system that has been running on paper promises for decades. Those promises are expiring. The question is whether you are positioned on the right side of history when they do.